welcome everybody to Property Thursday. I'm so pleased to get Richard on because there's nobody else I know that's as knowledgeable about property everywhere really than Richard. We work together and he probably spends 20% of his day scouring the newspapers, the Guardian, the Telegraph, the Times, and learning all he can about the property market, and he's going to share that with you today. So as you know, do it every week, and we'd like it to be interactive, so any questions, please put them along the bottom. So Richard, welcome. Sorry about the delay. Thanks for joining.
Thank you. My pleasure. No problem.
And I think we talked about it earlier in the week. We're going to make this informative. We're not going to concentrate too much on particular properties, although at the end I promise there are. And just, Richard, there have been reports in the papers that people have been moving out of London. The rents have been hit. Is this correct, or what does that mean for the market?
Yeah, I think, I mean, obviously, you know, with regards to obviously what we're talking about today, obviously the title being, you know, London and the Southeast and how it's sort of coming roaring back. And I mean, it's quite a good place to start. I think if it's possible, what I'll do, Chris, first of all, I'll just give a short introduction and then perhaps address that question, because there is, there is quite a lot to cover there. But just as a very quick intro as to who we are. So I represent the RPA Group, who in partnership with One Global, we provide a service to allow investors to buy into the UK, into the property market. And the idea is that we provide a sort of one-stop shop, end-to-end service, if you like, advising on property from a purely investment standpoint. The idea is that we can provide all the due diligence, the relevant background knowledge that anyone thinking about doing this, because it's not, if you're sitting at home thinking, I want to buy property in the UK and home being Dubai or somewhere else around the world, it's not necessarily that straightforward. And the idea is we take as much of that hassle away as possible for our investors who want to do it. And the key ultimately is identifying, as it is with any investment, obviously identifying the right asset, ultimately the right property, and that's the right property for you as an individual investor, which, to be honest, it might be different for you, Chris, than it is for me, depending on what we're trying to achieve. So I think with that in mind, it is very much an advisory consultative service that we offer. We work with, we work with the biggest names in the business. I mean, we're one of the projects that I was just going to show you at the end is a Barratt London site, which is obviously one of the Barratt Homes are the largest developer in the UK, and Barratt London are the largest subsidiary of them. And this is incredibly important part of it, because if you get in bed with the wrong developer or the wrong product, all that hard work and that sort of, in terms of earning that money to buy it can go down the drain. So I think what's important here to stress is that we are working with the best of the best. But I think to answer your question, would you mind asking me the question again?
Just being reports in the papers a lot. I was surprised we're doing London. I love London. I'm from London, but lots of people are moving out of London. Is that correct, or what do you think it's going to do to the market?
I think it's quite an interesting point, because obviously as everyone who will have seen the invite and joined the link today will have seen that we are here to talk about London, and so it's clearly, presumably, if we're talking about it, we think there's a good story there, and there absolutely is. But it is important to understand it in context, because if you're a buyer, an investor looking at UK property, and you're reading reports about, particularly since COVID, what's gone on in the London market, you might be forgiven for thinking that actually maybe it's not the right opportunity for you, or simply there isn't an opportunity. Over the last, there has been a change in the way people are living and renting and buying property since COVID. So the traditional in sort of investor type property was always the, you know, a one bed apartment, city centre, 2 minutes from the tube station, you know, and you know, it's difficult to go wrong with that. And to a large degree, it still is difficult to go wrong with that. But there has been a change in what people are looking for. So if you think back to, I mean, it's over a year ago now, amazingly, isn't it? You know, the first lockdowns and COVID hitting and all the rest of it. But you know, if you think that you're a young executive working in the city and you're spending a huge amount of money each month to work in, you know, to live 10 minutes away from Liverpool Street, for example, but you can only afford a tiny studio flat, and then the government says you're not allowed to leave that studio flat. It's you know, that's quite a thing, really. So there was a trend which to a large degree seems to have stopped now, of people moving out of London and away from kind of more city centre locations. As this isn't just London, this was also other cities as well, looking for more space, looking for more bedrooms, looking for perhaps a second room where they can set up an office or whatever that might be. And so there has been this trend, but there's been some really interesting data that's come out in the last particularly in the last sort of 3 to 6 months. You know, Chesterton's, for example, who are quite a big London agency, have said that their lettings team is the busiest they've been since 2006. You know, so Knight Frank have quoted, you know, because the government are now asking people to return to offices, aren't they? You know, there is this, you know, sort of back to normal life sort of trend that is ongoing. And so I think actually what we're seeing now is that sort of spread of people out into the suburbs, maybe into sort of commuter belt towns, has slowed down. But what that has meant, of course, is that, you know, prices also have come off in London. And so actually, when you're looking at it now, there is I would argue there's a real buy opportunity in London. You know, I mean, you and I have worked in London for years and years and years, and we both know that historically, over a longer period, London goes up in value. And if you can buy at a point when prices come down, that is a good time to do it. That would be my argument.
And you and I have spoken about this lots of times, and I think this is so important for our guys out there and our clients that are listening. Using other people's money, OPM, other people's money, leveraging, the power of leverage. And I know you've got some figures there. And again, yes. Excuse me, but this is what I wanted to talk about overall and why people should be investing in property. And I've just been on a very, very good webinar, and I just thought because I know you explain it very well, and I know you've got a couple of slides.
Yeah, no, absolutely. And I think actually I'll sort of skip around this presentation a little bit, because there's obviously quite a bit to cover. But with to answer that question directly, what we produce are cash flow analysis of the costs that might go into a typical property. So to answer your question, I've got a sort of a live example of, if you like, where I can demonstrate the power of leverage versus a cash purchase. So the reason why people borrow is quite simple. I mean, on a very basic level, it's the simple fact that if you look at this here, this is a property sort of pulled slightly at random. It's a one-bed apartment in Harrow. You know, really good commuter belt regeneration and sort of investment story going on in Harrow. So one bed apartments at 341,000. On a very basic level, one reason why people borrow is that, you know, your total cost going into that property are £140,000 as opposed to being, you know, £380,000. So that's obviously that's the first reason. And I'll come back to this in a minute. But where it's quite interesting, as you say, on the leverage side of things, is that when you've got, and in this exact example, a 65% loan to value, so 65% of the property is mortgage, so 200, in this case, £221,650 borrowing. at 3.5% over 25 years. If I move on to the next slide, the next screen, what I've got here is a scenario on the monthly income on a cash purchase on the left-hand side. So what you'll see, of course, is that if you buy in cash, your income is significantly higher because you're not paying out a mortgage. But where it gets really interesting is, and where I think that the power of the leverage is demonstrated, is the fact that your 10-year returns on a cash purchase are and I'll explain this in a second, at 62.7%, are significantly lower than if you borrow 65% and use other people's money, OPM as you called it, to actually finance that purchase. And this is based upon exactly the same growth sort of predictions. So we're using, in fact, I've got it here. We're actually using Savills growth predictions of 18.1% over the next 5 years, and ultimately, the difference is clear: 103% versus 63% returns over a 10-year period through borrowing other people's money. Now, there are situations where that might not be the right thing to do, because if you're buying for an income and you're retiring or replacing lost income elsewhere, then a cash purchase is a sensible idea. But does that make sense to you, Chris?
Well, I think on a simple case, you buy a property for 200,000 and you borrow, let's just say, just for argument's sake, round figures, 50, and it goes up by 5% a year, which is sort of expected at the moment. You've doubled your deposit in 5 years, and then you can maybe remortgage and move on to the next one. It's just there's nothing else out there. We don't want to start talking about cryptocurrencies or anything else like that, but there's nothing else like that you can actually leverage to that sort of extent and get the returns on. So that's great, and this is being recorded, and so we'll leave there. You obviously know the north as well, and the northern powerhouse as well, and you've obviously got properties up there as well. Between London and which we're talking about today, and up north, the London powerhouse, what would you say people should be looking at, and why today London?
So if I go back to the sort of the forecasts for growth over the next 5 years, I think if you were to look at the growth forecast for London and the southeast, say 3 years ago from Savills, you would have seen some significantly lower numbers, or not just Savills, from anyone. The simple reason was that the sentiment in the market for London just wasn't there. We were going through Brexit. London had a very strong run between 2009 and 2015. There are a number of reasons why London wasn't the best place to invest, and the Northern Powerhouse has been fantastic. It has performed exceptionally well. I think there is still growth and still opportunity up there, and if you're looking for a higher yield, then potentially that's a good story. My argument is quite simple with London, in the sense that we're now, for the first time in years, we are seeing growth. London, for the first 6 months of this year, has grown in value across the whole of London, and that's something that we haven't seen in the previous 5 years. In actual fact, prices have been tailing off. Central London prices in the last year went down anywhere between sort of 10 to 20% in some locations for sort of Zone 1 prime central. But we're now in a position where the numbers you see on the left are Savills. This is a report actually that came out last week from Knight Frank, and the numbers that we're being quoted here. So what we're seeing is the wider UK at 24%. Savills have got the Northwest at 28%, West Midlands at 24%. We've now got prime central London predictions from Knight Frank at 25%, prime outer London at 23%, and greater London at 18%. So these are broadly in line with obviously what Savills and the general sentiment in the market. And I think, you've been around longer than I have, Chris, but the truth of the matter is that if you can buy London at times like this, and the Southeast as well, I would include the Southeast in this, because the Southeast too, you know, and the home counties, surrounding locations, these are this is the property market within part of the property market within the UK that has driven UK property traditionally. You know, that is it's you know, the North has not ever been such a strong capital growth story traditionally as the Southeast has. And we're now in a position where we are seeing some pretty bullish predictions for London and the Southeast. You'll see here, you know, 17% for the Southeast as a whole. And I think that's probably a little bit undercooked from Savills quoting for the Southeast. So I think we're now in a position where, when you've got 14 million people within half an hour of central London and 9.5 million people in London, you know, the supply and demand dynamics are such that we should see some really significant growth moving forward. As far as London goes, it does come at a lower yield profile, but that's where actually, again, if you're looking at, you know, I included the Southeast in the sort of the headline, because in my eyes, some of the strongest growth regions now are the kind of commuter belt towns, market towns, you know, within half an hour of London, catering to those people that perhaps wants to move out and get a bit more space, but they still need to be, you know, they still need to be within striking distance of their office.
With Crossrail completing by the end of this year, and that's the link between the east side of the UK, if you like, across to the west, completing and bits of it opening all the time. And both of us have worked in that market where prices. Do you still see the growth in those outlying areas as well?
Absolutely. I mean, I think if you can at any time, and you know, this will be for, you know, pretty much any major city around the world you could care to look at in detail, I'd imagine, but certainly with London, and you know, any time there is a new infrastructure, transport sort of investment, you know, new transport links, anything that makes London smaller and effectively or more connected, you always see price rises. I mean, some of the projects that we're looking at are along Crossrail or linked to Crossrail, which, you know, we're finally now in a place where I know we were involved in it sort of 6 or 7 years ago, and it's only due to hand over at the end of this year. Or open, I should say, and have sort of running trains at the end of this year. So from that perspective, I think a large part of the opportunity with Crossrail was still to see, because people domestically who are buying to live in or renting, as opposed to buying as an investor, as we're sort of talking about, they've not yet moved to some of these locations or taken that opportunity of getting a bigger space for less money, because it's not actually open yet. So I think we'll see that. I think we'll see a significant jump in some of these locations next year.
And I think the same must be true, and we speak about it probably every week when it comes to HS2. Again, a few years off, but the same story. And really, when we're talking in these, and hopefully getting some questions coming in, it's usually down to what people not can afford but want to put into a property investment, and therefore it's not going to be central London, especially, is going to be quite expensive. If you go down to Kent and commuter areas, obviously it becomes more affordable. And as you go out to Birmingham, Liverpool, and Preston, which Holborn properties have got, you know, even more affordable. But we're here today to talk about London. What is your next slide?
Do you know what's interesting with that? With you know, you're absolutely right. Traditionally, the north has been cheaper. Absolutely. I'm from Kent, so you know, London's north for me. But you know, north of the Watford Gap is, in my eyes, you know, the Birmingham, Manchester, Leeds, Liverpool, all of these locations have traditionally been cheaper. But what's actually quite interesting now, and which is why I mentioned the kind of commuter belt zones around London, is that you can buy a flat actually with a higher yield and a cheaper pounds per square foot than you can in Manchester or Liverpool, and you're half an hour away from the biggest city in the UK. You know, so you know somewhere like, you know, there are locations. You know, traditionally, if you're thinking about commuter belt locations outside of London, you might look at Surrey or Sussex or Hertfordshire or, you know, Berkshire, you know, these sort of the home counties, which are traditionally, you know, they're the kind of the go-to. If you've got a bit of money and you're moving out of London, that's where you go. You go to Surrey or, you know, footballer territory.
But I think you just brought it up, and I think it's fair now to actually open up and talk about Ashford, because I think that's why a lot of people. But it's I'm amazed what you say. So what you're saying is I was right, but I was wrong. In fact, it's not that expensive. It is affordable.
It's actually not. No, but that's the thing, and that's exactly what I was going to say. You know, as I said just now, I'm from Kent. It seems to have improved since I've left, but but the point is that it's, you know, Kent is still a lovely county, still within a striking distance of central London, and it's significantly cheaper than a Surrey or a you know, commuter belt home county town, which is you're exactly right. These sorts of locations, a Woking or a Reigate or a Guildford, that these aren't cheap, you know. Whereas if there are opportunities in Kent, in Essex, in some of these slightly less fashionable counties, where you can still buy at a very, you know, at a very reasonable rate. I mean, maybe it's a good time for me to actually bring up the.
Please do.
So, just as a, you know, quick overview of the sort of thing that, you know, that falls into that category as opposed to being London. So this is a development called the Triangle in Ashford. I don't know whether we've got anyone from Ashford on the call. I grew up literally about 5 minutes away from here, and it's fair to say that Ashford, you know, 25 years ago was not that great. Truth be told, it was an hour and a half away from London on the old train. It was a relative, you know, it was in Kent terms. If you wanted to live in Kent and you were moving out of London, you might have moved to Tunbridge or Sevenoaks or Tunbridge Wells, you know, which are, you know, much closer to London, more salubrious, just more fashionable. But that's the interesting thing about this, and this is why ultimately we're in Ashford now, because Ashford is now the fastest growing town in the southeast. And as you can see here, you know, it's the reason people are moving to Ashford is because it is significantly cheaper than, you know, than London, as you would expect. But you can still be in London in 29 minutes. You know, Ashford is a sort of a developing town, as I say, the fastest growing town in the southeast. And with the new rail line and so on that has opened a few years ago now, but you can now be 29 minutes into London Stratford, which is a crossrail station, and you can be 36 minutes into St Pancras, so you can be in the heart of the city in 36 minutes. And this particular development is, you know, it's less than a 10-minute walk to the development, from the development to the station. So ironically, you can be door to door to Liverpool Street quicker than you probably could from Chelsea, you know, or the West End. And the difference in price is stark, you know. So here we are talking about one beds from £180,000. Studios from £180,000, one beds from 210, and yields of exceeding 5, so up to almost 6%. Whereas you simply cannot get that profile, I mean, in London, and you're even actually struggling to get that profile in places like central Manchester now. You just, you know, it doesn't really exist anymore. But and then the other thing, of course, with Ashford is that not only is it affordable and the transport's great going north, it's also extremely well connected to Europe. It is Ashford International. You can be in Paris in an hour and 52 minutes. Amsterdam in just under 4 hours direct, you know, so it is exceedingly well connected, and because of that, we are seeing an increase in businesses setting up there. You know, Amazon and Amazon Prime and Netflix are involved in this £250 million studio centre that's being built in some of the disused train station, I was going to say relics, not quite the right word, but, you know, the disused buildings that have lain empty for a while. So there's a lot going on. And I think if you're, traditionally there has been a move to look to the north and the northern powerhouse, but then it's performed exceptionally well. And my argument for London and the southeast is that it hasn't performed that well in the last 5 years. Prices have either remained the same or actually gone down, and so there is an opportunity there, because all these things go in cycles, to actually get in and do something quite interesting over the next few
Richard,
years.
could you go back to the slide where you got the studios, the 1 bedrooms, the 2 bedrooms? A question's just come in. So if somebody wanted a 2-bed at 250, we're talking about mortgages at 65%. I know people can go up to 70, but I always like to talk about 65. You're with an investment. What would you say not off the top of your head, for a 2-bedroom at 250? Somebody would need approximately about 100,000 when it comes to the legal fees, stamp duty, etc.
Yeah, probably just under. Yeah. And bear in mind, in this particular case, that would be split over. This is under construction. They're on site. It's a fully funded development. Excellent developer with a strong track record. It's a 15% payment on exchange and 5% 3 months later, and then 80% on handover, which isn't until Q1 2023. So we are, your initial, so for a 250 2-bed, you are, I suppose your initial costs are going to be about £50,000, so 20%, £52,000 with legal fees maybe, and then nothing else until handover.
And at this point, I'm going to, for our mortgage friend who's listening in, say we'd like to dip everyone when it comes to mortgages, get a decision in principle. So if anybody needs to do that service, they can come through us, we can do that. All it is getting all the information to the lender early doors. And then this may be too early doors, but if anybody's got any doubts because they're self-employed, then we're a great believer in getting in front of the mortgage people as early as possible. I can't say that strongly enough, especially with what's gone on during COVID and everything else. But no, that's great. And the 2023 is a long time off, so anybody is probably going to make money in the interim.
Yeah, absolutely. There's we're demonstrably well priced here, and there are. Actually, the interesting thing about Ashford is because Ashford traditionally is a place where it's been houses. It's been that. There are very, very few apartments, but there is an increasing demand for them. And actually, last week we actually revised the rents upwards slightly because the local agents basically who we price them up basically said there's nothing there. We'll get more for them. So. Right.
And anybody that's listening wants a personalised cash flow, then obviously, Richard, you can do that with the stamp duty and the solicitor's fees, etc. That's great. And what else have you got for us?
Well, I think the other thing I just wanted to highlight is, as another example, is Eastman Village, which is our kind of what I'd call our sort of commuter belt London suburb site. So if you want, because there's two arguments with London. There has been this move to the burbs, as it were, from people looking for a bit more space, people looking for a bit more outside space, and these sorts of things. And so a product like this really works. There is also a very strong argument, if you're not really focused on yield, to go and buy something in Zone 1, because actually there are prices available today that there just weren't 5 years ago. And I think if you're a sort of a long-term capital appreciation and sort of wealth protection, if they're your motives, then I think Zone 1 and Central London works really well. This is a bit more of your classic kind of investor type product. So it's being built by Barratt London, so a FTSE 100 company, the largest developer by volume in the UK, a very well-known name, and ultimately an outfit that you know what you're going to get. Ultimately, it does what it says on the tin. For those of you that don't know, Harrow's northwest London, just sort of northwest of Wembley, and it's Zone 5, so the pricing is very, very strong. You know, you can buy a 2-bed here, a big 2-bed for £450,000, a big 1-bed for £340,000, which by London standards is very strong. The yield profile is very good. It will rent all day long. But the interesting thing is, you know, what we're always looking for, as you know, Chris, is connectivity and reasons why a particular product is going to do well. You know, there's two things going on in Harrow. First of all, from Harrow and Wealdstone Station, which is less than 10-minute walk away, you are 13 minutes into London Euston, or you could hop on the Bakerloo and you go into the West End in half an hour. And then another thing is that this is part of, and really the key component of, Harrow Council's 2026 regeneration scheme, which is 1.75 billion investment programme going into Harrow and Wealdstone town centres. This site's actually quite interesting, because, and what you'll see here on the left is that, you know, this is a big site. Barratt don't just build one building. They'll build a big master plan community that completely transforms the local landscape. With this particular case, we're involved in Penrose, which is the last building within phase one. Phase one being this little bit here. And what's really interesting about that is that there is so much data out there in London that if you can be involved at the beginning of a wider regeneration site, your capital growth and your returns over a 5-10 year period are generally always significantly above what the average sort of growth might be. And actually, just to show you quickly, I've got a slide here on that. So this is a CBRE data from 2020, I think it is. But what it shows is that, you know, if the yellow bit is additional uplift created by wider regeneration in the area, you know, and so, you know, Royal Arsenal and Woolwich, and you've got Elephant and Castle, and all these, you know, and this is, you know, that's what we're going to see here in Harrow, because this is I mean, it's a famous old site as it is. It's the old Kodak, the original Kodak factory. And yeah, it's just a very solid, very strong investment. You know, every single unit's got outside space. You've got a park literally on your doorstep. And yeah, it's I think if you're thinking about London and you want a sort of more of a classic style investment, which is balanced between that yield and capital appreciation, this is that.
And it's a nice part of London, I always think, Harrow, actually, the public schools and stuff like that. I like Harrow.
Yeah. It's not, I mean, to be completely transparent, I mean, for those that you know Harrow, this is Harrow and Wealdstone, so this is a 5-minute walk away from Harrow on the Hill, which is the posh end of town, if you like. But that's exactly why we're here, because as this bit of Harrow comes up and is given a facelift, the values will rise more. And I mean, it's 10-15% more expensive, if not more, if you were to buy an equivalent development in Harrow on the Hill.
And I think the point is, and we talk about it every week on Property Thursday, it's all about supply and demand. And that part of London, people wanted to commute in, and you're on the west side of London, so you've got access if you want to go out to the countryside, or even for people who want to go to Wales. Got questions come in. Sorry, I'm just going back a bit. Ashford, near the train station. Might it be noisy? Thanks to Nigel.
No, it's a significant distance away from the track. It's directly opposite. I mean, you can't really see it here, but you're basically directly opposite Victoria Park, which is the sort of the largest park in Ashford. You've got a river directly in front, so just basically the other side here of the building. Got a river, the River Stour. It's called the Great Stour. It's not that big, but directly you've got the river, and then you've got the park. Behind, you've then got a road sort of coming this way. You've got a road, another row of sort of buildings, and then you've got the railway. So it's some distance away.
Richard, I've got a question that's coming, so I've got to read it out, and I hope it's not going to left side you. on Ashford, there are studios. We saw that, I think, from
Yes.
180,000. Have they been means tested with lenders?
Yes. Yeah.
Okay.
Yeah.
All right. The
So
question coming from Bob, yeah, that's good. Good.
Yeah, because I mean, yeah. So when I say these are studios, these are big. These are big studios. These are as big as a typical one bed in most other developments. You know, they're 460 square feet, 470 square feet. I think the smallest one's 440, but most of them are quite large. And before we, before we bring anything to market, we give it to,
of course,
the lender.
Yeah. No, Bob asked a really good question, because I know that some
Good
lenders do
question.
have restrictions
Good
on
question.
size of property, and we do the due diligence. I know I say it every week. We do. Not only is Richard and his company doing the due diligence, we're doing the due diligence. Andy Piggott's doing the due diligence. So we due diligence the whole thing down to we hope.
Is that a new? That's a new verb, diligise.
It is. It's a new word. It'll be in the Oxford by the end of the year. So, anything else you got there you want to share?
Not really. I think the last thing I would say, just to emphasise, just to go back a little bit, all the way. I just want to emphasise this slide, because I think this is super important for anybody that's looking to buy property. With rare exceptions, you need a balcony or a patio or a garden or a terrace these days. That is what people want. And so this is a survey that actually it's about 2-3 months old now, that Savills did at the end of Q1, and it is London focused, but broadly speaking, these trends, whether it's Manchester, Birmingham, London, wherever, this is what's happening, and this is why every single product we do will either have balconies on each unit or terraces, or it'll have some sort of communal roof terrace or gardens, or something along those lines. Because the most important thing previously to tenants and to buyers when they were looking for property is the purple dots, and that is, previously it was proximity to a tube station. That was the most important overriding factor as to why they chose an apartment. Today, it's parks, open space, outside space, and obviously, given the trend of people working from home and all these sorts of things, there is, that's a kind of logical progression, I guess. But it is worth mentioning, and that is because you are thinking about advising, whether you're advising a client of yours or investing yourself. I would strongly recommend that this forms part of your decision-making process. But that's kind of it.
Sorry, Wendy in Malaysia has asked me a question. Right, you might have covered it, but I apologise. From the station to Ashford property and station to Harrow property, any walking?
Yeah, I do. I've not walked the Harrow one, but I've walked the Ashford one many times.
Right.
So Ashford, according to Google Maps, it's 10 minutes, pretty much on the dot. The reality is, because of the slow walking pace that they always take into account, if you're walking at any normal speed, it's going to be about 6 or 7 minutes.
Okay.
From the Triangle to Ashford International Station. With Eastman Village, I mean, it will be, again, I think on Google Maps it says 11 minutes, so I would imagine it's going to be sort of 8 minutes or something like that. But with London, that's obviously anything 10 minutes or below is, that's what people want ultimately. So
thank you, Wendy. I hope that satisfies you over in Malaysia. Got to apologise to everyone that's missed this. I'm getting messages coming in because we were late starting, but Richard, thanks for sticking with it. It has been recorded and will be on our website, Holborn Assets Property, along with other webinars that we've done, including another one that Richard's done recently. So please have a look at that. Thank you to Miltos for staying patient. Richard, thank you very much indeed. Thanks for jumping on. Anybody wants any more information, obviously go via your wealth manager. You can contact me and I'll put you in touch with Richard and his team.
I would also, just to stress, Chris, I mean, I've literally mentioned 2 properties here, but we have a number of options across London, from a completed asset, you know, 2 minutes walk from Tower Bridge and London Bridge, you know, through to, you know, all sorts of different things. So there are across London and the rest of the UK. So
Yeah,
you know,
yeah,
these are two of our sort of more recent ones. But yeah, but thank you for your time.
No, thank you. Thank everybody. And I'll be speaking to people about why we were so late. All right.